All right. Welcome, everyone, for our panel discussion on who will fund the climate tech scale-up. I'm really excited about this discussion. We have participants from across the capital stack, as well as the entrepreneurial perspective with Arch. And we'll discuss how each different source of capital can work smarter together to help unlock more capital for climate and clean tech. And we'll also discuss practical strategies for founders who are in the room in navigating these different sources of capital. But first, I'll ask each panelist to give a short introduction on themselves and their organization. Maybe, Rajesh, we can start with you.
Sure, happy to. Been investing in climate now for about 17 years. I've been with Khosla Ventures for 6 years now. Before that, I was heading Applied Ventures, the venture arm of Applied Materials. We were doing a lot in solar batteries. That's when I met Nicholas. And great to see TDK flourishing really well under him. Khosla Ventures is $18 billion assets under management. We've been around for 20 years. We raise roughly a $3 billion fund every 2.5 years. Within that, we have a seed fund, a main fund, and a later stage fund. That's been very, very helpful because particularly for climate, you can't just be passionate, you need to have patient capital as well. So our seed fund is a $500 million fund, so we can write $2 to $10 million checks. The main fund is a 1.6, so we can write kind of 10 to 30, and the later stage fund is 50 to 75. We've been able to use all three for investing in the climate companies for a while. We are generalist as well. We have a healthcare group. We have enterprise software and AI. In fact, we were the first institutional investor in OpenAI. It's the same month we decided to invest in Commonwealth Fusion. I think both will be trillion-dollar companies, but one is climate, the other is AI, so timing is a little bit apart. But very committed to the climate stack. Super excited to be here.
Thank you, TDK, for having me here. I've been with Galvanize for approximately 10 months. Our credit and capital solutions strategy is relatively new. I'll tell you about it. But my background prior to that, I was at the Loan Program Office at the Department of Energy for a few years under the Biden administration. Prior to that, really been in the energy space my entire career, really on the principal investing side. I started off on the power side in the early days at Enron, and then spent a dozen years at GE Capital's GE Energy Financial Services, invested in power, renewables, midstream, really from a structured investment perspective. And as far as Galvanize, as you all probably know, it's a multi-strategy private equity company focused on the decarb strategy. We have a growth equity late-stage venture business that was formed in 2021. Credit and capital solutions, as I said, started recently. We have a $1.3 billion commitment with an SMA relationship. And really our goal is to really be the non-dilutive capital stream for companies that have proven their business model and they're looking to scale up, especially if they're an asset-intensive business. We would come in prior to accessing the bank market. The bank market is very rigorous in terms of their standards to provide lending. So we want to operate in that sweet spot where you're at a growth stage company and you're looking to really scale up and trying to get to the next phase for bank loan or even the larger infrastructure investors that ultimately will come in when the company's bigger.
Great, thanks, lovely to be here. Katie Fackler, I'm an associate portfolio manager on CalSTRS Sustainable Investment and Stewardship Strategies team. We affectionately call it SIS. As many may know, CalSTRS is the largest educator-only pension fund in the world. We have about $380 billion of assets under management. Our mission is to secure the retirement future of California's more than 1 million working and retired public school teachers. I help lead our SIS portfolio, which is an opportunistic multi-asset class mandate entirely focused on investing in climate solutions and the energy transition. It's intended to be additive to CalSTRS total fund. So what that means in practice is we invest across the risk-return spectrum, everything from early stage venture through growth, buyouts, private credit, infrastructure equity. We're intended to be at the tip of the spear for CalSTRS collaborative model. So we actually have like a very flexible mandate. We invest in everything from direct investments to co-investments, fund commitments, GP equity stakes, and joint ventures and other types of creative structures. Our mandate's to be 1% of CalSTRS total NAV by next year, so it's about $4 billion. And at this point, we've made about $4.5 billion in commitments, and across about 40 different types of investments, directs, co-investments, and funds.
Great. Good morning, everyone. I'm Arch Rao, TDK team. Thanks for having me here and also being a supporter of our growth over the last several years. I've been in the energy space for a little over 20 years now. I started off as an academic, ironically working on engines and power systems. And like any self-respecting entrepreneur, I dropped out of the PhD to start building companies. Some successful, some not so successful. But I've been working in the renewable energy space, building clean power generation with wind energy. Then I had the opportunity to work on energy markets and energy transactions. I was fortunate to work on energy efficiency, and then I led Tesla's energy group before I started SPAN in 2018. SPAN is a electrification company. We're really building digital infrastructure in the form of a smart electrical panel at the very edge of grid. And the thought process here is for us to leverage our existing infrastructure or capacity in our distribution grid more effectively so that we can electrify faster, be it for consumer beneficial electrification or manufacturing growth or compute growth. I think we can use our existing poles and wires more effectively, cost effectively, to help accelerate electrification. In terms of the stage of the company we're at, SPAN's been around for about 7 years. I've raised a little over $300 million to fund our growth so far. I'll tell you the last $50 million was harder to raise than the first $250 million. So I'm sure we'll chat a bit about that as well. But thanks for having me.
Thank you, Arch. It's incredible how much AUM is represented on this stage.
On that side of the stage.
On that side of the stage.
That's right.
We'll get there.
Yeah.
Rajesh, maybe we'll kick off the discussion with you, specifically drawing on Khosla Ventures' experience starting with Cleantech 1.0. What are the success stories or failures that most inform your approach today?
Oh boy. Thinking 17 years back can give you nightmares, but it's been a great learning experience. Lots of failures, some very good successes, but those failures teach you more than anything else. I think a couple of key intuitions we have developed, and we make those investments by design from that perspective, is we look for the highest technical risk, highest technical impact, but the easiest market entry. That's now sounds like an oxymoron, but the way we think about it, I can give you specific examples, is we always look for huge technical innovation. Otherwise, you don't have IP. You don't have like a world-changing company. But how do you get into the market faster by integrating into existing infrastructure? That's a key intuition that's been very, very valuable for us. I can give you a couple of examples just to drive that thought and not be too generic. We have a company called Forterra. Huge innovation on how can you take CO2, have it with calcium oxide, make a decarbonized cement. For cement, we didn't approach it as, can I come up with new materials? Because there was so much fancy in 21, 23 in terms of, next big technology leap and huge innovation. Whereas these guys focused on integrating into every cement factory. How do you make every cement factory your partner? You take the CO2 that's going out, put it back into calcium oxide, and get out the calcium carbonate. By that, you are actually increasing the throughput of every cement factory by 44%. So you're not talking about decarbonization at all. You're just talking about pure economics for existing cement plants and then telling them, hey, by the way, you don't have any CO2 emissions, right? Another example, we have a company called Calyx that's putting perovskite on glass. The beauty is now all you need to innovate is put a coating on a glass into the hundreds of gigawatts of solar plants available all over the world, and you increase the efficiency by 30%. That's really low capex, but high output, but you're integrating into existing factories. We have another company called Lancetech. Now that's a success story. They're in $45-50 million revenues. They have 4 plants in China, 1 in India, 1 in Europe. But the beauty is they're integrating into existing steel plants, taking the CO2 emissions and converting it to ethanol and then to SAF. That beats the heck out of any of the carbon electrolyzer and all expensive approaches where you're actually paying for the CO2. So that was a key intuition in terms of how do you build these companies, and we follow that to the T even today. I think the second was what we call as a Chindia price. We do look at the techno-economics as the biggest one we spend a lot of time on, even at the seed stage, Series A stage, and the later stage as well. We actually don't do any kind of IRR calculations for any of our companies. Might be funny, might be like counterintuitive. I used to do that at Applied back in the days, but we don't. We focus on techno-economics and very, very deep. If you look at Vertigy, which is a common company we have, when we incubated in 2020, 2021, our single biggest focus was, can you get to $3 per kilogram without subsidies? And that's the single question we have asked every year. And today they are at $3 per kilogram without any subsidies. And they'll be at $2 in 2 years. And they have a gigafactory, up and running today. So those things make a lot of difference. And I think the key intuition for me, for as an investor, either for our portfolio company or new companies that we invest in, focus on building a company to value rather than valuation. And that's a mantra we had even in 21 to 23, whether the companies we invest in, we talked to those companies and said, raise a lower amount of money, de-risk the top 3 that we all align on, the most critical risks, and then get fine at the other end of the table. Don't raise too much too early because it becomes too big to fail. And that happened in Clean Tech 1.0, happening in Climate 2.0. And so that's something we focus a lot on.
Thank you. So many golden nuggets, I think. Maybe from your perspective, what are the biggest hurdles in funding capital-intensive businesses before they reach scale? And how do credit solutions, or how can credit solutions help address those?
No, it's a great question. We are operating, at least as Galvanize Capital Solutions, we're operating really at the earlier stage when you think about providing leverage onto a balance sheet. Ideally, the goal is it's much cheaper than equity cost of capital. That should be accretive so that you can really start to scale these businesses. We invest in clean manufacturing, clean electrons and clean molecule project-oriented businesses. So what we'd like to see is ideally the time frame where we put in money is a pilot plant has been built so that we actually know what's happened and how did they solve the technical problem. And then there's usually a scale up. I'll give you battery recycling as an example. We'd love for the first line to get built to know that you've actually can produce at a ratable rate. And then if you want to add on the second line and third line, we actually have a really good underwriting based on what's actually happened on the first and second line. Like you, Rajesh, unit economics is where we focus on competitiveness, because as a lender, bank lending, they're going to focus purely on collateral. What is collateral? Collateral is going to be really from their perspective, what's there contractually from a revenue making or gross margin that's available. When you're doing earlier stage credit or capital solutions opportunity, we're really looking at unit economics and value, because we may not be able to get long-term contracts because the market isn't there for that. But if we can hang our hat on unit economics, that's very, very valuable for us from an underwriting standpoint. And so I think that's where we'd like to see, an entry point is something has been done in an area that hasn't been proven yet. Things that have been proven, battery storage, utility scale solar, CNI solar, energy efficiency. Those are a lot easier to underwrite, but still we can take the approach of, hey, when you're ready to build the next 100 of these, use our facility to use from a debt perspective, and then really build your topco growth with equity so that you have non-dilutive capital. So that's where the challenges tend to be, is have you gone far enough to kind of at least prove out that you can replicate it, and whether you have good unit economics. And that unit economics can stem from, ultimately production costs, but, we constantly have to underwrite some of the investment tax credits or 45X tax credits. We can certainly fit all of those things under the box, but over the long run, if you want to create equity value, you do have to know and show that there is a viable business that's being created. And that's really our entry point.
Thank you. Katie, from a pension fund standpoint, how are organizations like CalSTRS evolving their climate tech strategies, and what is really driving those changes?
Yeah, so I should say, just with a little bit of context, CalSTRS has been integrating and thinking about climate change in our portfolio for the past several decades. And we've been specifically investing in sustainability themes out of our public portfolio over that time. The mandate that I work on was started actually in 2021, and it really came out of CalSTRS seeing, and the board and senior investment leadership seeing an opportunity to generate alpha by investing in what we see as a major global trend to, frankly, decarbonize the global economy. So that really was the genesis of thinking about creating this specific, dedicated private market climate solutions fund. So we had sort of the benefit of some hindsight and some key learnings from Clean Tech 1.0 for thinking about what do climate tech companies need as they think about scale. As we designed our portfolio, as we designed our mandate, as we designed our investment policies. And I suspect that many in this room may agree that there's so much innovation that we're seeing with companies that are trying to drive climate solutions. There hasn't necessarily been the degree of innovation and flexibility in the capital solutions and the ways that we think about deploying capital to support those companies. And so really, like, our ethos has been, how do we think about, and it may seem, I love going after the keynote presentation, but it may seem a bit counterintuitive, how is this public pension fund thinking about putting innovation and flexibility as our driving ethos? But that's really what we tried to do as we thought about creating this mandate and portfolio. Everything from the mandate, the policies, like I mentioned, but even our team itself. And so maybe just to make that a little bit more real, I can give you guys 3 specific examples of how we're trying to do that in practice. So one is our mandate. Like I mentioned in our earlier remarks, we have flexibility to invest across the capital stack. We have 3 main buckets that we invest out of, which is private equity, private credit, and infrastructure equity. We're finding it very helpful to have that flexibility in our mandate, but I will say that we also intentionally designed it in a way that we can actually invest in things that fall outside of traditional asset class boundaries. And I think that's something, like, that gray area is really helpful, especially in climate. And in particular, we're seeing a lot of opportunities that fall sort of in between private equity and infrastructure that may have elements of private equity building, like buy and build type strategies, but in infrastructure related sectors. So you're getting that risk return profile that sort of blends some downside protection, but with some upside. And as we talked to other allocators, we saw that oftentimes it's really hard for them to invest in those types of opportunities because they just don't even know, from a policy perspective, from a team perspective, like, who should be driving that and who should be looking at those. So that's been something that's just been, like, really helpful for opening up the opportunity set for us. Related to that, I would say the team. We are one team. We are one team that does everything across the risk return spectrum, one investment committee meeting. And I think that that's really surprising for people when we tell folks, and it's been incredibly helpful both for gleaning insights. We try to think of it as like a flywheel that lets us see across the climate solutions value chain. It helps us get smarter as we continue to learn and take learnings from one part of our portfolio to other parts of the portfolio. It also, frankly, helps us win space in competitive rounds because, I can name a couple examples where we actually got space in a competitive equity round because the founder found out that, you're going to be needing infrastructure or project financing later. Like, they're like, who do you connect us to? I'm like, no, that's the guy sitting next to me. Like, it's one team. Like, we all do this together. So you're already getting familiar with that company and thinking about different ways to provide capital solutions. So that just opened up a lot of opportunity for us as well. And then the last thing I'll mention is just how we think about our partnership approach. Our goal is to be the partner of choice for our managers. I'm not sure if any of them are in the room today. I haven't seen them yet, but I'll let them, you can talk to them and decide if we're actually achieving that goal or not. But that's really the ethos that we start with and our goal. And we're trying, because we have this flexibility, we try to work with them. We have a concentrated book in terms of our managers. We try to go quite deep with them on how we can bring our portfolio and our different capital solutions to bear to be helpful across portfolio companies. And I think just because of the uniqueness of our mandate, where we are half strategic capital into companies and assets and half partnering and working with with managers that we think have differentiated skill sets. We really, when we think about how we even choose managers and how we think about partnering, like it's very much driven on collaboration, sharing insights, sharing co-investments, just like really thinking about how we can understand each other's unique perspectives and skill sets. We also do really try, I appreciated the comment earlier too about sort of how to think about being nimble. Like we actually really do try in our governance processes to be able to move quickly and nimbly on co-investments in particular, and trying to be able to actually help build syndicates, which is something that I know can sometimes be a challenge. So those are sort of all different types of things that we've taken into account as we've thought about building out the portfolio.
Arch, can you share something that you'd wish you'd known early on about navigating these different sources of capital?
How early on? Look, I think
yeah.
for better or for worse, this is my third time trying to build an enterprise from scratch, and I think there's been a lot of learning along the way. I'm assuming that my role in this panel is to be the contrarian, given that you're all representing the investment bench quite heavily here. We speak a lot about this in the context of climate tech, right? It's probably fair to say that whether you call it climate tech or what I think is more increasingly accurate, which is infrastructure tech, right? We're really building stuff that is designed to reimagine how we think about powering our lives, powering the burgeoning demand for electronics and compute and so on. It's more important now than before, I think, to think about this longitudinally, right? A lot of the companies, including ours, that we're building now are generationally relevant companies that will take multiple decades to cook, to mature, to become successful. Just sharing some data points, right? If you look at the history over the last 20 to 30 years of what you would consider successful, now publicly listed companies in the solar space, in the power electronics space, in the energy storage space, in the EV space, the average time to profitability is between 9 and 11 years, right, for these companies. And the average amount of invested dollars is usually to the tune of $1 billion of invested capital before they get there, right? Either because they're solving incredibly hard problems, i.e., they're solving scientific problems where there's a binary outcome of success and it takes 5 to 7 years even just to get the science right, or you have to get to a certain scale for the unit economics rationale to be real, right? At the scale that you're building, let's say at a pilot scale, even if you're building products for utilities, it is not immediately solving from a unit economic perspective until you get to a certain scale, right? So I think more than anything else, the biggest sort of learning, if I can sort of translate that into a nugget, is the importance of thesis-driven and longitudinally patient capital, right? And I think it's important from a founder perspective to find investors that recognize that who you're bringing capital in from might need to recognize that the amount of time it takes for your business to mature is typically longer than the fund life cycle, right? And what does that mean in terms of what you expect from them versus what they expect from you in terms of growing the business is critically important. We've been fortunate, and again, this comes from having not done it right in the past. We've been fortunate to bring on board investors that I think we've set the right expectations with. We're not, maybe this is the wrong thing to say in this audience, we weren't trying to become profitable in a hurry because that was the wrong endpoint to get to in 4 or 5 years. We were trying to build a technology set that was going to be materially differentiated from an IP perspective, was going to give us a dramatic lead in terms of incumbent solutions, was going to allow us to build credibility segment by segment. Like today, for those of you that may not know, Span builds a product called a smart panel that sits in your home, and I'll give you the most simple example of how you might experience it, right? How many of you here own an EV or drive an EV? Okay, it's about a third of the room, let's say. How many of you have had to add an EV charger at home when you bought an EV? What subset of you needed to upgrade your panel or your electrical service in order to add the EV charger, right? There's about 15 to 20% of customers that do that. And that number is growing because 2 out of 3 homes in the US are going to need an infrastructure upgrade to accommodate this new roughly 10 kilowatt load, right? What we've designed is a system that obviates the need for a very expensive distribution system upgrade because your existing 100 amps, which is a 24 kilowatt service, is abundant to be able to fully power your EV charger. And what we do in a clever way is act as a router for electrons, if you will, much like a router manages bandwidth for data, right? And we're able to throttle an EV charger, throttle a compressor, manage a set point of a water heater, if you will, and allow you to fully electrify. Now, extrapolate that. We had to do that at a premise level, at a single home level. deploy that through D2C as a business model, scale to now become a B2B2C business, where we have 5,000 plus SPAN authorized contractors around the country and several hundred profit centers or distribution centers around the country. We had to get to that level of having tens of thousands of endpoints before we earned the right to sit in front of a utility and say, hey, this can now be used as a grid asset, as a distribution asset. We have the reliability data, we have the manufacturing scale, we have the lived experience of customers that we can bring to you, and then translate that into something that now solves for unit economics, where the utility can effectively give it away at no cost to the customer, because that is significantly cheaper than building more poles, wires, and transformers, right? So I think that has taken us 7 years to get to this point. Had we started a company and said in 2018, I'm going to go and sell a $2,000 device or $1,500 device to a utility, we would have been walked out of the room, right? That combined with now the confluence of the growth in demand and what is increasingly we talked about, the importance of affordability, right, is I think making our play really, really relevant. And it requires investors to be able to look at that narrative arc over that extended period of time, and not just through the lens of fund time horizons or what otherwise looks like very sexy exits that you can get in short-term investments, right?
That's interesting. Maybe building on that, I'd love to get the perspective of the investors in the room. What does the exit pathway look like today for climate tech innovations, and in this environment, assuming you're not a AI energy company, and how do investors and how can founders really prepare themselves for that reality today?
Happy to take it. We certainly have companies that we have been investing for 17 years that some have gone public and some will go public in the next couple of years. But it depends on whether they have integrated into a plan, whether they have at least built a first of a kind plan, shown the unit economics, so you can show that to the public market you are going to rinse and repeat the same stuff. You have de-risked the technology. So there are some things in cement and a few other areas will go public in the next couple of years. And we do think even as extreme as a nuclear fusion, I'm taking that as an example because that's the other extreme end that you can think of. We invested in Commonwealth fusion in 2018 time period. By 2027, early 2028, there will be not a question whether fusion would work, because they would have proven Q greater than 1 and Q greater than a much higher numbers as well by then. And then you still have to do the system level de-risking to get to commercial in 2030, early 2030s, right? But if you have shown the proof point that this technology works and fusion and geothermal are the only way to power all those data centers, that's a huge opportunity, right? So I am optimistic on some of these things getting to the IPO and getting into the public markets. Really, there is no other way to power the data centers. You can't just power your way with more coal plants or natural gas plants. You have to get nuclear at some point, long term. We're not big fans of fission, but let's just talk about fusion. Geothermal will be there in 27, 28, 29. In fact, we have a company that's doing 400C versus everybody at 200C. If you can do 400, you get 10x more power, 10x more enthalpy, 10x more heat, far lesser number of drills. So that means suddenly, 5 cents per kilowatt hour is perfectly possible for the data centers that are getting built. So data center AI, despite all the hype, is driving some real good investments into the right areas within climate as well.
I mean, I will say this, there's been a trend, and we've seen this over the last maybe few years, where people are taking development companies public, right? And it's an interesting strategy. Once you're public, there's a focus area, a lens on you. And while it opens up capital markets for significant amount of capital to grow these businesses, there was a nuclear company that just did this that's going to focus on Texas. The challenge is you have to meet your development milestones, right? And as soon as you run into problems with development milestones, that's when being public can be very painful, because you're a marker of you're not meeting your milestones. So I do think, we hope, like some of these companies that are very good at execution actually show that they can meet these milestones, benefit from the capital markets being out there to really grow this. And that provides ultimately a great exit for the earlier investors. So I do see that as a trend. And then obviously the secondaries market has been burgeoning over the last 10 years for various sectors. I'll pause. I know other people can talk about that.
Yeah, I'm happy to jump in as well. We've been having a lot of discussions with our partners about what the exit and liquidity, especially as an LP, like what does that look like? When is that coming? And we've been having a lot of discussions about having to think more creatively than just IPOs and than just sort of this mega exit. I think that two things that we're actively seeing, we are seeing more secondary opportunities come up. We're actually looking at a handful of opportunities right now. I think that, and I would definitely be curious for others' perspectives, I think the challenges we're seeing there is it feels like if you're a software business, like the market is a bit clearer and more established for secondaries. I think what we're seeing with some of our more deep tech, like hardware-driven companies and managers that focus there is the market just isn't really there yet. And so it ends up being a much longer process, much more bespoke, much more about sort of connections and who you know. And so I do think that there's sort of like growth that's needed there, but we're seeing interesting opportunities come up for everything from reasons as broad as just brand and reputation risk and people not being allocators for various reasons, not being able to be associated with things that just have the word green in the name, which is unfortunate, but it has come up. To folks that are having strategy shifts, whether it's, family offices, strategic, like CVCs, where that's no longer a fit for their mandate. And so it's not that they don't see an opportunity there, but they're selling to folks that actually are looking for liquidity. So we are seeing things there. And then we're also just seeing just more strategic M&A type opportunities come up. And I think a lot of our, especially venture managers, like didn't necessarily always want to go that route. Sometimes it's like a smaller and companies, right? And like sort of how they think about that, how they think about the right fit. Is that going to be a smaller exit? But trying to be more intentional about getting in the room with those types of players earlier on, even being more intentional within the skills and that they're bringing to companies about what's needed to set that up for success, whether it's really thinking about like your patent portfolio, thinking about board governance, being mindful there, thinking about the types of skills that you need that will make that an attractive target. So we are definitely like seeing different types of opportunities.
Look, the last 12 to 18 months have been anything but predictable, right? I think it's been interesting to see a couple of trends, at least from my vantage point. I'm, as much as I enjoy hanging out with investors, I don't think I wanted to spend 150 hours with 150 investors over the last year. But I think the patterns that have emerged are a few things, right? One, since the pandemic or post-pandemic, the supply chain crunch sort of coupled with sort of the growth in demand created an interesting opportunity for industrial strategics to actually grow rapidly in their enterprise value. So they've actually been able to create a lot more enterprise value, and some of them are trading at unusually large multiples of top line, like 5x, 6x for traditional companies that are 75, 100 years old. That's never been the case, very rarely been the case, I should say, rather, in the past. Combine that with the geopolitical uncertainty that's been introduced over the last, let's call it year and a half, and specifically in the climate space, you can debate whether this is good or bad, has created a vacuum. There are a lot of VC tourists or climate tourists that have now left the VC space. Private equity firms are understandably more conservative in terms of what you want to invest in. You want to invest in things that are defensively EBITDA positive already or going to be predictably EBITDA positive in a short horizon. That leaves a large number of companies in this weird chasm of having been very meticulously focused on growth-based execution and now suddenly having to pivot rather quickly to show an execution velocity towards profitability that is hard to do, right? There are, I can point to a number of examples: Northvolt, Natron Energy, FreeWire, like arguably good technology companies, but maybe not yet at the place of having the metrics-driven sort of model to back the investment thesis completely fall out, right? So I think the narrative is certainly shifting more towards whether you think about it in terms of exit or in terms of continuity, right? For us, I think about it in terms of business continuity and making sure that the last 10 years of investment in science and R&D and engineering is realized in terms of actual value in aiding this transition. And I think that's going to come from, again, large PE firms with a thesis-driven model that are focused on value and not valuation. The valuation correction has already been happening and happening rapidly. And I'm actually of the point of view that founders should welcome that correction, because that's more important to see your technology be scaled and deployed than it is to over-index on valuation, which quite frankly, is a little too frothy anyway in the last several years, right? And the second part of it is being really hyper-focused on execution towards a path to profitability. And that allows you to bring in strategics that can look at it through their lens even and say, look, we can get behind this. We can actually be a catalyst or an enabler of commercial growth for you and have a two-way benefit there. Right.
Thank you. So many insights from this discussion. Time flies when you're having fun. I had 5 other questions, but I think I'll allow the audience to ask some questions. We've got a couple of minutes left.
Arch, I think you welcomed a follow-on question when you said in your introduction that the first 250 million were easier to raise than the last 50 million.
Yeah.
We've pointed to a lot of macroeconomic factors around that, but would love to hear more about your thoughts around that and why that has been.
Yeah, okay, I'll try to be as polite and honest as possible. Look, I think the short version is there was just a lot more funds at play in the last 5 to 7 years, and I think the intent to invest capital was perhaps stronger. And now, at least from what I've seen, there has been a understandable, noticeable shift further to the right in terms of the conservative lens through which people are deploying capital. I don't think that, I mean, correct me if I'm wrong, the capital is still there. It's just that the rigor that goes into investing that capital is much higher. So it takes twice as many conversations, it's twice as long now. The first 5 rounds that we did, seed A, A1, B, B2, I'm not a fan of the nomenclature, it's going to end up being that way, were all 3-month efforts from start to finish, right? And we were very, very milestone driven in how we reached out to investors. And to Rajesh's early point, it was like at every stage we were very clear on what we were going to de-risk about the company. It was technology de-risking, product market fit de-risking, manufacturing de-risking, scale de-risking, as the case may be. Now, I think the lens has shifted entirely to the other side of what is the lowest OpEx model you can show us. And can you show us 8 different scenarios of the OpEx model that gets us there, right? What is the, maybe simplifying it in the interest of time, right? As an entrepreneur, my operating model is to plan for success. But I think as an investor now, everybody's planning for failure. And that's incongruent. We need to find investors, especially in this space, that are able to sit next to you and say, what does success look like, not what does the worst downside case look like, right? If we get there, capital formation will become a lot easier in a hurry.
I mean, Arch, do you think the lens of government policy also has played into a little bit of kind of the capital decision? It feels like this ebbs and flows. This goes back to like stable government policy for like 10, 20 years actually allows the capital markets to do its job to get unit economics down, because it takes a really long time to get unit economics down because supply chain has so much to do with it, and it takes a long time to build a supply chain.
Yeah, look, again, having lived this in a parallel life almost at Tesla, right, which was heavily dependent on subsidies, heavily dependent on LPO money, et cetera, to grow. One of the things that I was somewhat hedonistic about when I started Span was we needed to build a product that had day zero economics, was viable, absent of subsidies, absent of incentives, absent of tax credits, et cetera. And I think that's important for a business in general to be viable, but especially in this space, right? But it's also a little bit of extracting signal away from noise, right? If you look back at the last 12 months and all the tariff noise that's created, fundamentally all that's created was distractions for businesses. Nothing fundamental has changed, right? I think there are some businesses that were perhaps heavily path dependent on things like tax credits that obviously have gotten walloped in the last year and a half, and those weren't your VC investments anyway, right? Those are probably publicly listed companies, those are probably project finance companies, et cetera. I think if you're investing in technology companies, you're able to ignore the noise to say, this is not a administration-dependent success story. This is a core technology and infrastructure solution-dependent success story, right? The sort of, again, oversimplification of this analogy for me is think back to 2005 and where we were in the telecom sector. Nobody knew that each of us were going to have 1 or 2 devices that was constantly streaming media content, right? But we had the prescience to say we're going to go build the infrastructure to then be able to support the large amount of now data that's going to pass through these wires. And we did that. We invested in that, and now we have a dramatically accessible sort of internet, if you will, right? I think we're in that inflection point for energy or energy infrastructure. We need to be investing into the next 10 to 20 years, not looking back or looking myopically down.
Unfortunately, we have to stop the discussion, but good news is we have a networking break, so we can have more discussion back there in the atrium. Thank you. Thank you very much.